If you think investing is about chasing hot stocks, following social media tips, or doubling your money overnight, then you're setting yourself up for disaster. The truth? The real path to wealth is not exciting. It's slow, steady, and brutally disciplined. In The Intelligent Investor, Benjamin Graham, the father of value investing, reveals why most people fail in the stock market, not because they lack intelligence, but because they lack the temperament. And in this journey, you're about to learn how to think like a true investor, protect your money, and grow it over time without losing your sanity in market chaos. So, if you're ready to transform your financial mindset, stick with me till the end. Because here on Shiny Books, we're not just reading books, we're building life-changing blueprints. Before you start throwing money into the stock market, you need to understand that not all investors are created equal. Benjamin Graham makes this crystal clear. There are two main types of investors, and your success depends on knowing which one you are. The mistake most people make? They try to be both at the same time. That's like training for a marathon while also trying to bulk up for bodybuilding. You'll end up exhausted and get nowhere. The first type is a defensive investor. This is a person who doesn't want to spend hours analyzing balance sheets or tracking daily market trends. They value safety, stability, and minimal stress. For the defensive investor, the goal isn't to beat the market. It's to protect capital, earn steady returns, and avoid unnecessary risks. Think of this approach like driving within the speed limit. You might not get to the fastest, but you'll arrive safely with less chance of crashing. The second type is the enterprising investor. This is the one who's willing to put in serious work, studying companies, evaluating industries, and pouncing on opportunities when the market misprices something. But even here, Graham warns, being enterprising doesn't mean being reckless. It means being informed, patient, and selective. Enterprising investors can achieve higher returns, but only if they have the discipline to avoid chasing every so-called opportunity. Now, here's the important thing. You can't just declare, I'm going to be enterprising, because it sounds exciting. This decision depends on your temperament, your skills, your available time, and most importantly, your ability to stick to a strategy without letting emotions hijack your decisions. If you don't have the time or desire to study investments deeply, Graham says you should be a defensive investor, and there's no shame in that. In fact, for most people, this is a smarter route. Let's break down what each type actually does. A defensive investor portfolio is simple, high-quality bonds, and a diversified set of reliable, large company stocks. No chasing startups, no gambling on penny stocks. No, this stock is going to moon nonsense. The defensive investor uses index funds or blue-chip stocks, and they rebalance periodically, usually once or twice a year. The enterprising investor's portfolio, on the other hand, might include undervalued stocks, small-cap gems, or special situations like mergers and spin-offs. But here's the twist. Graham says even the enterprising investor should avoid speculation. Every purchase must be backed by thorough research and a clear margin of safety. They aren't throwing darts at a board. They're acting like detectives searching for overlooked value. So, how do you figure out which one you are? Let's do a quick self-check. Ask yourself, do you actually enjoy reading company reports, digging into financial statements, and comparing industry trends? Do you have the patience to wait months, or even years, before an investment pays off? Can you remain calm when the market tanks, or will you panic sell everything? If you answered no to most of these, congratulations, you're likely a defensive investor. Your job is to focus on consistency, not excitement. And trust me, this is a good thing. The defensive approach may not make you the richest person at a cocktail party, but it will keep you from going broke. If you answered yes to most of those, you might fit the enterprising mold. But here's your warning. Overconfidence is a killer here. Too many people think they're enterprising when they're just gambling with more expensive chips. Graham's rule is clear. Only pursue the enterprising strategy if you're ready to treat investing as a serious business, not a hobby or thrill ride. Now, there's a deeper lesson here that Graham keeps hammering in. The type of investor you should be chosen for life, not based on your mood, not based on market hype, and definitely not based on your recent wins or losses. Switching strategies back and forth is like switching diets every week. You end up confused, frustrated, and with no results to show for it. One of the most powerful things about this classification is that it removes ego from investing. If you're defensive, you don't need to feel inferior to the enterprising crowd. If you're enterprising, you don't get to feel superior just because your strategy takes more effort. Both can succeed if done correctly, and both can fail if done recklessly. And remember, Graham isn't telling you this to limit you. He's telling you this to protect you. The truth is, markets are brutal to those who don't know who they are. If you pretend to be something you're not, the market will expose you sooner or later. Think about it like sailing. The defensive investor sails close to shore, where the waves are smaller and the journey is safer. The enterprising investor ventures into deeper waters, where the rewards can be greater, but so can the storms. If you take a small sailboat into a hurricane, it doesn't matter how confident you feel. You'll be swallowed. Here's where the real magic happens. Once you know your category, the rest of Graham's principles fall into place. You stop chasing tips from friends or reacting to every piece of market news. You stop comparing yourself to people with a completely different investment philosophy. And most importantly, you stop making decisions based on fear or greed, because your path is now clear. In other words, before you even buy your first stock, you must decide which investor you're going to be, and then commit to it with full discipline. That's your foundation. Without it, every other principle in the intelligent investor will crumble under pressure. Once you decided whether you're a defensive or enterprising investor, Benjamin Graham hands you one of his most brilliant tools, the concept of Mr. Market. This isn't a real person. It's a metaphor for how the stock market behaves. And if you understand this one idea, you'll instantly have an advantage over 90% of investors. Imagine you own a small business with a quirky partner named Mr. Market. Every day, Mr. Market knocks on your door, offering to either buy your share of the business or sell you a share. Some days, he's wildly optimistic. He believes the business is going to explode in value, so he offers to buy your share for a ridiculously high price. Other days, he's deeply pessimistic. He's convinced the business is doomed, so he's willing to sell you a share for dirt cheap. Now, here's the catch. Mr. Market's moods swing wildly for no logical reason. He's not necessarily reacting to changes in the business itself. Most of the time, he's just reacting to his own emotions, rumors, or random events. Graham's point is simple. The stock market is exactly like Mr. Market, full of irrational ups and downs that have little to do with the true value of the companies you own. The beauty of this analogy is that it shows you your real job as an investor. You're not there to argue with Mr. Market, predict his moods, or let him influence your feelings. You're there to take advantage of him. When Mr. Market offers you a great price, you can sell. When he offers you a bargain, you can buy. And when neither price is attractive, you simply ignore him and do nothing. Most investors fail here because they let Mr. Market's mood swings control their behavior. When prices are high, they get greedy and buy more. When prices crash, they panic and sell. It's the exact opposite of what a rational investor should do. Graham is clear. You must reverse this instinct. Be greedy when others are fearful, and be cautious when others are euphoric. Think about how most news headlines are designed to manipulate Mr. Market's emotions, and yours. If a company misses earnings by a few cents, the stock might drop 10% overnight, even if the business is still fundamentally strong. On the flip side, a single piece of hype can send a mediocre stock soaring for a short while. If you react emotionally to these movements, you've already lost. Here's where temperament becomes more important than intelligence. The intelligent investor doesn't get excited by short-term spikes or devastated by short-term drops. They view stocks not as lottery tickets, but as ownership in real businesses. This mindset completely changes how you interpret market fluctuations. Graham's Mr. Market teaches patience. You don't need to respond to every movement. In fact, Graham says that your default reaction to most market action should be to do nothing. If the underlying business you own is still strong, temporary price swings don't matter. This is where many people struggle, because doing nothing feels like you're missing out. But in reality, doing nothing often protects you from making costly mistakes. Let's bring this to a personal example. Imagine you buy shares of a company you believe in. Let's say it's worth $100 a share based on your research. The next day, the market drops and the stock falls to $80. most people would panic, thinking they made a bad decision. But if the company's fundamentals haven't changed, this drop is simply Mr. Market being moody. For a true intelligent investor, this is an opportunity to buy more, not a reason to sell. On the other side, let's say that same stock suddenly jumps to $150. Everyone is excited, saying it's going to $300 next. The intelligent investor doesn't get caught up in this hype. If the stock is now overpriced based on its real value, it might be time to sell and take the profits before Mr. Market swings the other way. Here's the critical takeaway. Mr. Market works for you, not the other way around. You're not obligated to do business with him every day. You only act when the price he offers is clearly in your favor. The discipline to treat the market as your servant and not your master is what separates long-term winners from everyone else. Graham says the moment you start seeing market prices as opinions instead of facts, you stop making emotional decisions. You stop chasing trends. And most importantly, you start investing based on value, not hype. There's a quiet power in this approach. It frees you from the constant noise of the financial world. You stop refreshing stock apps every hour. You stop caring about what CNBC or Twitter is saying. You start thinking like a business owner who's focused on the health of the company, not the short-term voting machine of the market. If you internalize the Mr. Market analogy, you'll notice something incredible. You become calmer. You stop reacting. You wait patiently for opportunities, and when they come, you act decisively. You're no longer a victim of market swings. You're the one quietly benefiting from them. And in the long run, that patience pays off in ways you can't imagine. Because in the world of investing, the patient investor is the one who wins, while the emotional investor ends up funding everyone else's gains. If there's one golden rule in the intelligent investor that could save you from catastrophic losses, it's this: always insist on a margin of safety. Benjamin Graham didn't just invent this phrase. He built his entire investing philosophy around it. And once you truly understand it, you'll never look at an investment the same way again. So, what exactly is a margin of safety? Think of it like this. If you're building a bridge that needs to hold 10,000 pounds, you don't design it to hold exactly 10,000 pounds. You design it to hold 30,000 pounds. That way, even if there's an unexpected overload, the bridge still stands. In investing, the margin of safety is the difference between the price you pay for an asset and its true value. The bigger the gap, the safer you are. Here's why it matters. Markets are unpredictable. Even your best research can be wrong. Unexpected events can happen. Economic crashes, management scandals, technological changes, political upheavals. If you buy something at or above its fair value, you have no cushion when things go wrong. But if you buy it well below its intrinsic value, you've got room to absorb the impact and still come out ahead. Graham's method starts with determining intrinsic value, the actual worth of a business based on its assets, earnings, and long-term prospects. This isn't about guessing where the stock will trade next week. It's about calculating what the company is fundamentally worth. Then, you only invest if the market price is significantly lower than that value. Let's say your research shows a company is worth $100 per share. If you can buy it for $70, you've got a margin of safety of 30%. This gap protects you from being wrong in your analysis or from the market turning against you temporarily. Even if you misjudge and the real value is only $90, you still bought it cheap enough to avoid a major loss. Without a margin of safety, investing becomes gambling. You're betting that the future will play out exactly as you expect. And let's be real, almost never does. With a margin of safety, you don't need to be perfect. You just need to avoid paying too much. Now, here's the part most people miss. Margin of safety is not just for buying stocks. It applies to all kinds of investments, bonds, real estate, startups, even buying a used car. Anytime you pay less than something is truly worth, you give yourself a built-in advantage. The challenge is that it requires patience and discipline. Sometimes the market doesn't offer bargains for months. That's when most investors get restless and start lowering their standards, convincing themselves that this is good enough. But Graham warns, never compromise on your margin of safety. It's the only thing standing between you and disaster when the unexpected happens. Let me give you a real-world perspective. During the dot-com bubble of the late 1990s, investors were paying insane prices for internet companies with no profits, no solid business models, and often no actual products. There was zero margin of safety because prices were based entirely on hype. When the bubble burst, those stocks collapsed by 80 to 90%, wiping out trillions of dollars in wealth. The people who insisted on a margin of safety avoided most of that pain because they refused to overpay for something that had no proven value. On the flip side, during the 2008 financial crisis, fear drove prices so low that many high-quality companies were selling at massive discounts to their real worth. That's when the patient, disciplined investors stepped in, buying great businesses at fire sale prices with huge margins of safety. Within a few years, those investments multiplied in value. It's not glamorous. Buy with margin of safety means you're often purchasing when everyone else is scared and selling when everyone else is excited. It requires going against the crowd, which can feel uncomfortable. But as Graham says, the intelligent investor is not swayed by the moods of the market. They are guided by logic and value. The margin of safety also forces humility. It's a constant reminder that you could be wrong, and therefore, you must protect yourself from your own errors. It's not about ego. It's about survival. If you can remove the need to be right all the time and replace it with a need to be safe all the time, your investing will transform. Think of it like wearing a seatbelt. Most of the time, you won't need it. But when you do, it can save your life. Your margin of safety is your financial seatbelt. It's the difference between a setback you can recover from and a disaster that wipes you out. In the end, Graham's advice is brutally simple. Never buy an investment without a margin of safety, and never compromise on how big that margin should be. If the price isn't right, walk away. Opportunities always come back around, but once you lose your capital, it's much harder to get it back. And here's the thing. Once you commit to this principle, you stop feeling pressure to act on every market movement. You're no longer chasing the next big thing. You're waiting patiently, like a hunter who knows that sooner or later, the perfect shot will present itself. And when it does, you'll take it with confidence, knowing you've built in protection you need to survive and thrive in any market. If knowing your investor type, understanding Mr. Market, and using a margin of safety are the pillars of intelligent investing, then this section is about the foundation that holds it all together, your psychology. Benjamin Graham makes it crystal clear. It's not your IQ that determines your success in the market. It's your EQ, your emotional intelligence. Why? Because in investing, the enemy isn't just the market. The enemy is you. Your fear, greed, impatience, and overconfidence are constantly whispering in your ear, urging you to abandon logic and make impulsive decisions. Let's start with fear. Fear shows up when the market drops, when a stock you own starts tanking, or when headlines scream about recessions and crises. Your instinct tells you to sell before you lose everything. But here's the irony. Most of the time, selling in fear locks in your losses. You turn a temporary dip into a permanent defeat. Graham warns that intelligent investors must train themselves to remain calm when everyone else is panicking. Now, let's talk about greed, the flip side of the coin. Greed whispers to you during bull markets, when prices are soaring and everyone seems to be getting rich. You start feeling like you're missing out. You buy more, often at inflated prices, because it feels safe when everyone else is buying too. But that's usually when you're most at risk. Graham says that one of the hardest skills to develop is the ability to walk away from a sure thing when it's overpriced. Then there's impatience. Investing is a long game, but human nature craves quick results. You might buy a stock with solid long-term outlook, but after a few months of sideways movement, you start doubting yourself. You sell it, only to watch it skyrocket later. Impatience robs you of the rewards that come from letting compounding do its magic. Graham's advice here is blunt. If you can't hold an investment for years, you shouldn't buy it at all. Overconfidence is another silent killer. Maybe you've had a few big wins, and now you feel like you can't lose. You start taking bigger risks, ignoring your own rules, and chasing returns instead of protecting capital. Graham points out that the market has a brutal way of humbling anyone who thinks they're invincible. So, how do you protect yourself from these psychological traps? Graham suggests turning your investing into a disciplined process rather than a series of emotional reactions. That means setting clear rules for when you'll buy, when you'll sell, and what you'll avoid, then sticking to those rules no matter what the market does. For example, you might have a rule to only buy when a stock's price is at least 25% below its intrinsic value. If the market is euphoric and prices are sky high, you simply don't buy, no matter how tempting it is. Likewise, you might set a rule to sell when a stock becomes significantly overpriced, even if experts say it will keep climbing. These rules act like guardrails, keeping your emotions from driving you off a cliff. Graham also advocates diversification as a psychological tool. It's not just about spreading risk. It's about keeping you calm. When you own a range of investments, one bad performer doesn't sink your entire portfolio. That peace of mind makes it easier to stick to your plan during market turbulence. Another powerful technique is reframing how you see price movements. Instead of viewing drops as losses, see them as opportunities to buy good businesses at a discount. Instead of viewing spikes as proof that you were right, see them as moments to check if the stock is now overpriced and worth selling. In other words, detach your self-worth from your portfolio's short-term performance. Long-term perspective is your greatest weapon. If you believe in the intrinsic value of your investments, short-term volatility becomes irrelevant noise. Graham repeatedly reminds investors that stocks are not lottery tickets. They're pieces of real businesses. Would you sell your house just because its estimated value dropped this month? Of course not. The same logic should apply to quality stocks. And here's where the intelligent investor's mindset shines. You learn to expect volatility rather than fear it. You see it as a normal, even necessary part of the process. Without volatility, there will be no bargains to buy or overpriced stocks to sell. Mr. Market's mood swings are what give you opportunities. Your job is to remain emotionally steady enough to take advantage of them. This emotional steadiness isn't natural. It's a skill you develop through experience, reflection, and discipline. You'll still feel fear and greed. You just won't let them control you. It's like being a professional athlete under pressure. You don't magically become fearless, but you've trained yourself to perform despite the nerves. Benjamin Graham's message here is simple but profound. Mastering your own psychology is more important than mastering the market. You can have the best strategy in the world, but if you abandon it during a panic or a frenzy, it's useless. The intelligent investor's real edge isn't stock picking. It's self-control. And if you can build that self-control, you'll find that investing becomes not just more profitable, but more peaceful. You stop obsessing over every headline. You stop comparing yourself to others. And you stop letting temporary swings dictate permanent decisions. You become, in Graham's words, truly intelligent, not just in knowledge, but in temperament. Now it's time to put everything together. Your investor type, your understanding of Mr. Market, your commitment to a margin of safety, and your control over your emotions, into a lifelong investing strategy that actually works. This is where the intelligent investor stops being theory and starts becoming a practical roadmap. Benjamin Graham's first piece of advice is to make your investing approach boring in the best way possible. That means your portfolio shouldn't feel like a casino or a roller coaster. It should feel steady, predictable, and manageable. If you find yourself constantly excited or terrified by your investments, that's a sign you're speculating, not investing. Let's start with a defensive investor strategy, because Graham makes it clear this works for the majority of people. The foundation is balance, holding both stocks and bonds in proportions that suit your comfort with risk. Graham often suggested a 50-50 split as a baseline, with adjustments of no more than 25% in either direction. So in a very bullish market, you might shift to 75% bonds and 25% stocks to protect gains. In a very bearish market, you might go 75% stocks and 25% bonds to seize opportunities. This disciplined rebalancing ensures you're buying low and selling high automatically, without letting emotions decide for you. For stocks, the defensive investor focuses on quality and diversification. Graham recommended large, financially sound companies with consistent dividend records and solid balance sheets. You're not chasing hot industries or startups. You're investing in businesses with proven stability. For bonds, safety is paramount. Stick to high-grade government or corporate bonds that are unlikely to default. The enterprising investor strategy builds on the same principles but requires deeper research and a more hands-on approach. Instead of simply holding large, stable companies, the enterprising investor hunts for undervalued opportunities, stocks that are temporarily mispriced by the market. This could mean small-cap stocks with strong fundamentals, companies in turnaround situations, or special scenarios like mergers and spin-offs. But even here, the margin of safety remains the non-negotiable rule. Graham also emphasizes the power of dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of market conditions. This smooths out your purchase price over time and removes the stress of trying to time the market, which is nearly impossible to do consistently. Another key element is avoiding speculation. Graham isn't against taking calculated risks, but he insists on clearly separating speculative bets from true investments. If you want to speculate, maybe you buy a tech stock you think could explode. Treat it like a side hobby with a small portion of your portfolio, no more than 10%. This way, even if it goes to zero, your core investments remain safe. The intelligent investor also keeps expenses low. High fees eat into your returns over time, and Graham knew that compounding works both ways. It can grow your wealth, but it can also compound your costs if you're not careful. This is why many modern interpretations of Graham's advice recommend low-cost index funds as a cornerstone for defensive investors. Perhaps the most important part of a lifelong strategy is accepting that you will be wrong sometimes. Even the best investors make mistakes. Graham's point is that if you have a margin of safety, diversify, and control your emotions, those mistakes won't wipe you out. You'll survive to invest another day, and survival is the name of the game. You also need to measure success the right way. Graham warns against constantly comparing your returns to the market or to other investors. Your goal is not to beat anyone. It's to meet your own financial objectives with the least possible risk. This means focusing on long-term growth and stability rather than chasing short-term bragging rights. Finally, Graham insists that the intelligent investor sees investing as a lifelong habit, not a one-time event. Markets will rise and fall, crises will come and go, and trends will shift. But if you stick to your principles, knowing your type, treating the market as your servant, buy with a margin of safety, mastering your emotions, and following a disciplined plan, you'll not only protect your capital, you'll grow it steadily over decades. This is the real secret. The intelligent investor isn't someone with insider tips or superhuman prediction skills. They're simply someone who has the patience to stick to sound principles, the humility to protect themselves from mistakes, and a discipline to keep going no matter what the market throws their way. If you can build your strategy around these truths, you'll find that investing becomes less about stress and more about confidence. You'll stop feeling like the market controls you and start realizing that you control how you respond. And in the end, that's what will make you not just a good investor, but an intelligent one. So now you've got the blueprint straight from the intelligent investor, a timeless guide that has protected and grown wealth for generations. But here's the thing. Knowing these principles is worthless if you don't apply them. Are you going to keep letting Mr. Market dictate your emotions? Or are you going to take control, set your strategy, and stick to it no matter what? Start today. Decide whether you're a defensive or enterprising investor. Commit to only buying with a margin of safety. Build the discipline to see market swings as opportunities, not threats. And above all, keep your emotions in check, because they're your greatest risk. If you found value in this breakdown from Shiny Books, don't just stop here. Imagine what could happen if you applied these principles for the next 10, 20, or even 30 years. The compounding effect could change your entire financial future. So, hit that subscribe button right now. Give this video a like if it opened your eyes, and drop a comment telling me which of Graham's lessons hit you the hardest. Let's build a community of intelligent investors, because the market will always test us, but together we can pass every test.